Hello traders, Corey Mitchell here with TradeThatSwing.com. In this video we're going to look at the historical returns of the S&P 500. We're going to look at 5 years up to 150 years. As we're going to learn, the S&P has not been around that long, so we'll go through what preceded the S&P 500 and where this data comes from. We're going to look at all the up and down years that have occurred, biggest up and down years, what it kind of looks like to be an investor over the long term. We'll look at a chart going back to 1871, just looking at how we always hear that the stock market always goes up. What does that always actually look like? How has that unfolded? We have some dead decades where returns were negative or minimal. So we'll go through all of that. And if you just want the quick summary, this is basically what the stock market has produced. So this is as of the end of May 2025, and this is using the average price for the month. And so over the last 150 years, you're looking at about 9.3%, and this is including dividends but adjusted for inflation. So right around 7%. Over the last right up to the last 20 years, inflation adjusted, you're in that 7-8% kind of area with returns around that 2% mark. More recently, probably one of the best investing environments most of us will see in our lifetimes. And 10-year average return 12%, 5-year average return 16.4%. Pretty incredible. Even with adjusted for inflation, that's about 11% per year. I go through it in a little bit more detail. You can see, over the last 150 years, what it was with dividends, without dividends. And with dividends or without, of course, you're getting the dividend. If you're invested you're getting those dividends. What including dividends means is that those dividends were reinvested, right? As opposed to you just taking the dividend and spending it. You can see the difference in return because now those dividends end up compounding each year, right? You reinvest them and then they make 10% the next year. And then the next year, those dividends that you made make 10%. So you get a compounding effect. And without dividends, you can see the returns drop off significantly, probably about half. The ultimate return drops by about half if you just take those dividends and you don't reinvest them. This is over 150 years. Most of us don't live that long. Of course, and so over the last 100 years, but you can see the same thing. So dividends play a significant role in the overall return, but of course, you did get to spend those in real time if you're not taking them out. So most of us have about a 30-year kind of investment horizon. Once you start like really having some money to put in, and then you get to retirement. For most people, that's about 30 years, starting when you're about 30, and then once you get to about 60. Starting to look to pull it out. So 30 to 40 year investment horizon, maybe 50. You can see what those returns are. You can see the dividends play a little bit less of a factor because you don't have those extra decades of compounding, and an extra decade of compounding is huge. The earlier you can start your kids just even passively investing, making this 10% a year, every decade extra counts. It's a massive amount. We saw these numbers, 12% more recently, 16% over the last 5 years. That even includes, the bigger drop we just, with the Trump administration, we had that big sell-off and then we rallied all the way back. So this is basically this is what has happened going back to 1871. And I'll flip back to where this data comes from in just a minute. But 1871, we start out here. And we have this choppy period. It's basically 21 years of sideways movement. And this doesn't include dividends. This is simply the index price. So it doesn't include dividends. So, you still would have been collecting dividends and making some return. And depending on where you bought in here, if you kind of buy near the lower end of the range, hey, you're not too bad off during this period, but it's still a long time of pretty much sideways movement. 17 years sideways here. Then we have the run up, the roaring 20s they called it. Then we enter the Great Depression, Stocks drop 86% and take 25 years to recover. So if you bought up here, it took 25 years to recover. If you started buying somewhere in here, it didn't take that long. Plus you had the dividends, and so you would have recovered quite a bit quicker. Then we enter this major bull market, and that goes from let's say 1940 up to basically 1970. So you have about a 30-year run to the upside. Then you get an 11-year sideways period. The upswing starts around, let's say, 1975, ends right around 2000. So you have a 25-year run to the upside, and then you get 13 years of basically sideways. This one, 2008, 2009, let's say it bottoms in 2009. If you're looking at that, 25 to 30-year bull market, then, that puts us out to, let's say, around 2035. So this would be a relatively brief bull market that if this were to end now, but of course this is we only have a small sample size here. We're only dealing with a few, so I wouldn't put too much stock in that. But you can see there are these major, the main takeaway is that you have a major bull period, which we are in, which makes investing seem very easy. Then you enter these decade-long sideways periods, sometimes longer, where it's a lot tougher investing environment. And I don't know. So this lets you know kind of what typically happens, and you can plan accordingly. If you're investing kind of each month a little bit, right? So during this decline, you would have ended up with kind of an average price in here, right? So it didn't take you 13 years to get your money back, really, right? You bought, and then you bought here, and so here you would have been above water and making nice returns, and then you keep, you're buying throughout, and then so kind of anytime you're above this average price, you would be in a profit. Plus you're getting your dividends, so it's not quite as bleak during these sideways periods as it looks. If we're just I just passively invest a little bit each month, and I just keep adding to it, because over the long term, this is still a nice long-term uptrend. Let's go back. I got a little bit on, where is it? Here. So the S&P 500 has not been around for 150 years. The S&P started in 1957. Before that, it was the S&P 90, which was introduced in 1928. And prior to that, we have data such as the Cowles Commission. Robert Shiller's done a lot of work on compiling data going back a long ways. And so we have this data going back to 1871 based on these different sources. And then we have the actual indexes, the S&P 90 and the S&P 500 from 1957 forward, and the S&P 90 from 1928 up to 1957. So let's look at some of the biggest up and down years. You have 1930, 1931. Big drops, minus 47% in a year, minus 38% in a year. So while we talk about this average return kind of 10% per year, which is what you hear often, you sit through some nasty years to get that, right? But then these are typically followed. If you look at 1928 was up 37%. Then you have 1930, which is down 28%. Then you have 1931, which is down 47%, but 1933 is up 46%, 1945 up 40%, 1937 down 38%. So you have, that was a very volatile time, as you can see. Huge up and down moves. And while we haven't quite had those swings since then, it still can be, 2008 minus 38%, and then, 2013 plus 30%. So these are just some of the biggest ones. Here shows every year. So you can see way back in the 30s, huge moves, but we still have these, 30% down moves in a year occasionally, but then they're followed by 20% upside. So it's just, a lot of people think like, I'm just going to make 10% a year. It's super safe. It's going to be easy. Sometimes it's not. You're going to get, shaken up by these big declines. So you really got to decide what kind of investor you want to be when you're looking at this sort of stuff. These are all the returns by year. Have some other stuff on here, just, things, maybe some investment strategies, but really, I don't try to beat it. It's the S&P 500 is already a strategy in the sense that it is the best or a profitable mix of the 500 biggest companies. If you fall out of there or you become unprofitable, you're booted out and a new company comes in and takes it. So it's constantly getting pruned of crappy companies. So it is a strategy. It's buying kind of the best companies out there in the US. And so I don't try to beat it much. I just buy a little bit each month of S&P 500, and I'll buy some NASDAQ type ETFs or something, and I just chip away at them. But yeah, this just talks about some longer term stuff and strategies. One thing to note here about people who try to beat sort of the S&P, this was from JP Morgan. And this doesn't include dividends, but during this period from 2000 and 2020, they have a great insight because they have lots of clients. They can see how people are doing in their accounts. So we have the S&P 500 was up 7.5% per year during this period. The average investor made 2.9%. Now they may have had a mix of different things, but basically if they had just stuck with a simple ETF, just bought it, held it, bought a little more every month or every couple months, they would have got 7.5% plus their dividends. But most people try to get too fancy with their investing, and in doing so, they end up with a worse return. And while everyone says, well, that's probably not going to be me, this is the average return from hundreds of thousands of clients. Or what I assume would be at least tens of thousands of clients. And yeah, so this is an investing article. It looks at the long-term returns. Use it however you like, but I do like the passive investing approach where, I just buy a little bit. And then me personally, I also am a swing trader, a day trader. That's where I do my shorter term stuff. But I do like to have some just locked away in some long-term accounts, benefiting from the overall long-term rise, even though there's some rocky periods. I like this. Overall uptrending, good way to build wealth, as we can see. Even after inflation with dividends, we end up with some pretty good returns. So that is how the S&P has performed. This is as of the end of May 2025, looking at the long-term averages. Happy investing out there.